Okay, what's going on, everybody? It's Mitch here with another episode of the Small Town Housing Show. And for anybody who's new to the show, we're here every week up until next month because I'm taking some holidays, and we're talking about economics, local statistics, the Peterborough housing market, politics at our local level, and everything to do with the macro picture to help you make better housing decisions. And so a little housekeeping item before we dive into what we're going to talk about this week. Just like the buyers appear to be on holidays in this real estate market, I also would love some holidays. So I am going to go ahead right now and preemptively tell everybody that after this episode, the next 2 months, I'm going to plan to do just a monthly market update when we have the total monthly statistics in, unless any major catastrophic headlines that need dissected come through. I'm going to plan to take the next 2 months, so July and August, to really just enjoy my family, get some things done around the house, hopefully do some camping, and live life. So just be aware, if you see me miss a week, that is a planned power outage. So let's dive into it. I'm going to go through a bit of an itinerary here for you guys, and then we'll just start going through things. So we're going to go through the 7-day stats. Want to do a bit of a brief overview about what's happening out there with showing activity. Going to go through the 30-day in terms of where our total inventory has landed with the recent changes that we've had. And then just want to talk about interest rates and what the most likely scenario is if we were to view things graphically over the next 6 months here, because there's a lot of people, that seems to be the topic of choice right now, is when we see a bottom, what's the picture going to look like from there? We know there's a lot of buyer demand on the flanks, sort of people sitting on the sidelines, and that there's still a ton of buyer demand pending in the background. But what's it going to mean with the new cost of money? In terms of people's borrowing and how far they can leverage themselves, what is our recovery going to look like, and what will the new normal be in terms of a price equilibrium? So all good stuff. Totally going to be my speculative guesses, but we'll just talk through a few things. And I think that's pretty much it. I'm going to leave you guys with a little send off, and away we go. So let's talk about the 7-day review here. So for everybody who's watching the show, we're going through this every week. It's been very helpful to break what's happening in the market down into more, micro manageable chunks to spot trends ahead of when they might really already be appearing in the monthly pattern. So 81 new listings in the last 7 days. This is Peterborough County residential. 54 firm sales. So it's 27 net new listings on the market in that time frame. That is significantly less than the 41 last week, and that number was significantly less than 70 the week prior. So interesting. We saw like the high for a weekly period just in the middle of June, and already now towards the end of June, tapering back to some more average numbers that we've seen this year in terms of the inventory growth overall. So still growing, but the rate is definitely slowing. So, okay, here we go. 3 consecutive weeks in a row, the speed at which new inventory coming on decreases. Do we see a flattening? The 30-day activity is looking relatively similar to what it did mid-month, but a little notch higher. So we had currently right now, just in the city of Peterborough, 207 active listings, 101 pending listings. So that is a months of inventory of 2.05. So slightly higher than what I had posted for the middle of the month, which was in the 1.9s. So a little bit higher, not drastically, but we are over 2 months now. And so on to showing activity. Talk to any agent out there. Anybody who's got a house listed, the showing activity is virtually zero right now. Listings that are turnkey, attractive, well priced, or even underpriced, getting 1 to 2 to 3 showings a week. So it's really crazy. The buyers are just totally on holidays. They're there. We know you're there. I know you're there because we have lots of buyers ourselves that we were working with right up until when things started to shift and pivot, and they're all just taking their time, and rightfully so. So there's plenty of people in the back burner, and they're just total herd mentality pulled back right now. So when is that going to shift, and what's going to happen when it does? An interesting sort of little roundabout you can do to go through and play through this, because at times it could seem that the markets are already overreacted to what's happening right now and sort of its future forward projections about what the new normal for the market's going to be. But just playing around some basic numbers in a mortgage calculator. So our market right now, you're seeing a lot of numbers around the Toronto suburbs that things are down, 15 to high teen percentages, a lot of places 20%. Within Peterborough, I've seen numbers ranging, definitely double digits, depending on your neighborhoods and your comparable sales you're looking at and how desperate each individual seller was. I'm seeing quite a range, but in those mid-teen numbers in terms of from the peak to now. And what's interesting is that if you go back to the very start of the pandemic and even the middle of the pandemic, and you take the variable interest rates at those times and you go ahead and impose over what your payment would be, how different it is right now at the current variable rates and what the variable rates will be if they actually pull through with a 0.75 basis point rate hike in July. What you're looking at is that we are still kind of under what the interest rate change has represented in terms of people's monthly payments and their ability to stretch themselves or what type of payment they can afford. So let's just run through a couple basic examples because I think that's helpful. So if you take, currently right now, the average Big Five bank out there has got a variable rate at 3.25%. If we see 75 basis points in July, that's going to move the variable rate up to 4%. We're not even talking about fixed rates right now because just people aren't even choosing to take those. So I'm looking at what are the variable rates right now and what are they going to be. But what were those rates in the past? People who bought at the peaks. Now, albeit the peak really was a few months ago, and the rates weren't as low as they were in the middle of this. But in terms of what people locked into or signed up for in the middle of the pandemic, what were people looking at? You had variable rates getting as low as 1%. You had fixed rates getting as low as 2% in those but you could have cases that were slightly over, slightly under both those numbers, depending on A lender, B lender. But those are the broad strokes. So what does that mean? When you look at a payment of 1.5%, let's say most people locked in at a variable rate somewhere along the line of the last 2 years in the pandemic of 1.5%, or that's not what they locked in for, so to speak, but what they bought. That's the payment that they agreed to sign up for. On a $600,000 mortgage, so roughly a $750,000 purchase price with your down payment, $600,000 mortgage, your payment would be right around $2,400. At the old rates of 1.5%. Now at our current rates, or if you shoot ahead and go, okay, let's look closer to 3.5%, that raises your monthly payment about $600. Now that's about a 25% difference in your monthly payment. So for prices to be down mid-teens, 15% over under, still isn't totally in line with where those interest rates are right now in terms of how much people's payment has changed or their ability to lever themselves up and max out their payment has changed. And that's going to move again. So if we take that and move it from, let's say most people locked into these 2% fixed rates, and that was really the worst of the damage, or that along the continuum here in the latter half of the real estate spike, that people were locking in more closer to 2% rates. Still, if you see the variable rate go up to 4%, that represents a $624 increase roundabout on your payment from 2 to 4%, and that's about a 25% difference as well. So any way you slice it and dice it, it looks like for the most part you can show that people's monthly payment on a $600,000 mortgage might change by about 25%, unless I am totally using my mortgage calculator wrong. So if anybody wants to fact check me on that, I welcome it. But that's it. So what does that mean for the new normal going forward? I mean, first of all, let's talk about affordability. There's so many first-time buyers. I had people that I worked with in the past that we looked for months and months and months, didn't find anything, and they see these prices dropping and messaging me and saying, I'm really looking forward to the, finally my chance is coming. But when we look at affordability, it has not changed. When you just do the simple math, and I shouldn't say it hasn't changed because every situation is different, but I mean, come on, look, when your payment has, when the interest rates have moved enough to change your monthly payment on something by 25% and the prices have dropped in the mid-teens, a relative basis, your affordability has not gotten better. So it still means that although the market is much less competitive now, so you have a lot more ability to pick and choose, you have a lot more time to make your decision, a lot more comfort in the process. In all likelihood, you're not going to be that much getting that much more bang for your buck in terms of what you go ahead and buy at this exact point in time. Because yes, the purchase price can be lower, but your monthly payment is going to be the same as it was in the past if you had bought something that cost you more to buy initially, but the servicing cost was lower. So what does that mean for the future and beyond? I mean, obviously every indication out there is that we are just coasting towards a recession. Lots of talk about a potential reversal as soon as we see some major wobbles in the economy in terms of the Bank of Canada's direction and their rhetoric and signaling. And I think we would need that for the market to have any kind of meaningful rebound at this point, because even though the demand is there on a population basis in terms of the raw arithmetic on units available versus populants looking for a home and new populants that will be here via immigration, it still doesn't add up. I mean, if people can't get the money, they can't spend more. So the only way that I would see, because in my mind, part of me, in conversation I've had with people, there's the theory that there's so many buyers waiting. And I do really, truly believe that there's so many buyers waiting to enter the market that what we thought is that as soon as people see it bottom out, that there would be a rather speedy shoot up to whatever the new equilibrium will be. Not likely that it will be as high as the past heights because the old interest rates allowed things to hit heights that can't be repeated at the current time because incomes haven't changed and the interest rates just simply can't go back to as low as they were. So the leverage is not there for people to those prices to be reached. And of course, everyone's gonna be a little leery. There's gonna be a little bit of PTSD in terms of the sort of bubble syndrome in terms of everybody not wanting to rush back into a new up down cycle. But we see that as soon as things have bottomed out and there's any kind of indication, which in my own opinion, or at least the way logically I would think would happen, is that it would likely coincide with whenever the Bank of Canada signals, okay, we're done. We think we've hit our mark with where interest rates are going to stay for now. We're going to hold still. And then when they hold still several meetings in a row, and then at any point if they indicate that they might actually go backwards once they realize they've totally nuked things, I think that as soon as they signal, hey, we're probably actually going to, dial it back a little bit here, then at that point, people, in my opinion, most of us as realtors guiding our buyers and most buyers watching the headlines are probably going to say, okay, here we go. Time to get in. Now, as we see the cost of borrowing potentially going backwards a little bit, or at least staying the same, most people are going to have a little more certainty that it's time to move forward. And there's so many people ready to pile in that I think as soon as prices start to move off of whatever the bottom at the time is, that you're going to have a lot of people want to pile in and capture on the perceived bottom prices. But then the question is how high can it rise from there? I think it gets back to whatever the new normal going forward will be rather quickly. So you see a bit of a spike, a bit of a blip, and then curbed future growth that won't be at the level that it was, back to healthy normal levels, below double digits a year in terms of annual appreciation. But the question is how high is that level? And nobody knows. But I just don't think that it's high as the levels of the past were, because mathematically it's just not really possible at this point in time. But everybody says, well, what about the population crisis? What about the housing crisis? Unless one way that some areas of the prices, what will happen is there's not going to be broad strokes. Like I don't think that the Canada-wide and province-wide prices can just boom, recover right back to where they were once people have perceived there's a bottom, and then everyone piles back in. But pocket by pocket, I think there will be pockets that shoot back up. So to me, it's logical that condos spike because they're the price bottom. To me, it's logical also that cities like Peterborough, the cities on the peripheral, see a large spike again, because in absolute terms, people will not be able to afford downtown GTA core and the GTA suburbs just the same, because incomes haven't moved and they are not set to move meaningfully in any period of time in between here. So when everybody jumps back in and things are on the rally, and it appears that, buy now, because if you buy later, it's going to be more expensive. And then we have the population waves coming in. I think as people continue to pile in and the scarcity reveals itself, that there's two things: is you go for the lowest price thing you can buy in your city, which is for everybody's going to be to pile into condos, or you go back to drive till you apply, which means that for anybody who lives in the GTA peripheral, talking Pickering, Ajax, and anybody who's in Oshawa. So if they still can't afford to buy something at the new lower prices because the interest rates are higher, but they see that the prices are actually starting to rise again, and they're panicking, they want to get something to lock themselves into a price and receive the future appreciation, then there really is no alternative than for them to go to the most affordable place that they can stretch to be able to commute and still work, or work mobile if that's an option for them. And then I think it puts all the places that represent the lowest tier small and mid-sized cities in Ontario back in good positions to see a big uptick again. So that represents, the Peterborough, Belleville, Kingston, Windsor, Niagara are really, I would say, the big five that come to mind for me, other than some of the northern provinces that are a little bit out of my expertise. But when we talk about the Greater Golden Horseshoe, those are the five to come to mind. So I think that for all the headlines that have gone around about Canada, Peterborough being the most overvalued market in real estate market in Canada and all this stuff, I think that for as much as we're dropping right now, I do think that when things do start to recover, that us, along with some of the other small and mid-sized cities that I named there, could be some of the quickest to reach what would be the new normal in terms of their prices. And I believe that those prices could close the gap a little bit, where, say, for example, over the years, historically, there's been, just this consistent buffer of $150,000 price difference between what you can get here and what you can get in Bowmanville, Newcastle, Oshawa. They always move in lockstep, because why would I pay any more to be in this community that is that much further from my job in the GTA? And so we always move in this lockstep pattern where if Oshawa drops, we drop. If we move up, Oshawa moves up, because they are dependent on each other as comparable cities. Now, what might happen, a theory, is that you could see that gap close a little bit, because the competition is still there. It's still real that people need housing. But in terms of people's absolute ability to lever themselves will be decreased. There could just be a bit more of a flattening, and the whole bottom end gets risen up, and so the middle kind of gets compressed a little bit from top to bottom. But who knows? That's just a theory. Talk a lot about this stuff and talk with a lot of smart people about it, and we all seem to always veer towards the same conclusions, and that is where the conversation always seems to converge towards. So that's it for this week, guys. I hope everybody enjoyed. Hope you got some value out of that. For anybody out there who wants help and wants to start having the discussions going forward, the team is here and happy to help you guys out. So feel free to reach out to me, shoot me a line. And just, feel free to introduce yourselves to us. And I am really looking forward to holidays. So you might not catch me for face-to-face or a Google Meet in the next month and a bit. But you might be able to catch me via email, and we have a great team of people here that are all like-minded and willing to help you guys out. So I hope everybody is having a great summer. I hope everybody else is planning to take some time off as well. Hey, and one last update in regards to a last podcast, the Path and the Tiny Homes update. Had some great feedback on that. People are certainly interested in the topic of tiny homes and helping the homelessness issue. But there is definitely many sticking points in private conversations that people have brought up to me about a project like this. And I'm going to address all those in a more pointed format in the future. Potentially going to be starting with a bit of a blog here as well. And so that's something that might be better addressed in a point-by-point format, because I am somebody who doesn't have the greatest command over the industry language in terms of that space, and I certainly only hope to ever speak about it in a way that's helpful, and I never want to upset anybody, so it might be something that's better for me to pursue the written word rather than the verbal, because it's a little bit easier to control what I say there. So, but nonetheless, we're going to update you one way or the other, whether it's a video or a blog post, and hopefully continue to progress that dialogue. So thanks, everybody. Have a great week and a great month, and look forward to catching up with you on the next market update. Take care.